Hello students, welcome to this lecture on sources of long-term finance. Sources of finance means the ways for mobilizing finance to the business organizations. In other words, these are the sources from which firms raise the money required to fulfill the short-term as well as long-term financial requirements. Long-term finance is required to be invested in fixed assets of the business, whereas short-term finance is required for investment in the working capital. The first important source of long-term corporate finance is equity shares. Equity shares. Equity shares are those shares which are ordinary in the course of a company's business. They are also called as ordinary shares. These shareholders do not enjoy preference regarding payment of dividend and repayment of capital. Equity shareholders are paid dividend out of the profits made by a company. Higher the profits, higher will be the dividend, and lower the profits, lower will be the dividend. So, equity shares are also known as ordinary shares or common shares. Equity shareholders are the real owners of the company. They have a control over the management of the company. Equity shareholders are eligible to get dividend if the company earns profit. It means if there is a loss to the company during a particular year, the shareholders will not get any dividend during that year. Equity share capital cannot be redeemed during the lifetime of the company. The liability of the equity shareholders is limited to the face value of the shares purchased by them. And we will see the features or characteristics of equity shares. The first characteristic is related to maturity. Second, right to income. Third, claim on assets. Fourth, voting rights. Fifth, preemptive right. And the last one is limited liability. Now, let us see the important features or characteristics of equity shares in details. First, maturity of the shares. Equity share capital is the permanent long-term capital which has no maturity period. It cannot be redeemed during the lifetime of the company. Second, residual claim on income. Equity shareholders have the right to get income left after paying fixed rate of dividend to preference shareholders. Out of the earnings of a company, first of all, interest is paid to the lenders or creditors. After that, tax is paid to the government authorities. Now, from the income after tax, a fixed rate of dividend is paid to the preference shareholders. And after paying such preference dividend, whatever amount of profit remains, it belongs to the equity shareholders, and out of that profit, dividend is paid to them. Third, residual claims on assets. If the company is wound up or closed down, the ordinary or equity shareholders have the right to get the claims on assets. However, they have a residual claim. That is, the assets will be first used to pay off the creditors and lenders, then to the preference shareholders, and lastly the equity shareholders will be paid. Fourth characteristic is right to control. Since equity shareholders are the real owners of the company, they have the power to control the management of the company, and they have power to take any decision regarding the business operations. Fifth characteristic, voting rights. Equity shareholders have voting rights. They can vote in the meetings of the company, annual general meetings. With the help of voting power, they can make or change any decision of the business concern. Equity shareholders can also nominate proxy to participate and vote in the meeting on their behalf. Sixth characteristic is preemptive right. Equity shareholders have preemptive rights. The preemptive right is the legal right of the existing equity shareholders. As per the provisions of the Companies Act, whenever a company is planning to raise additional finance by issuing equity shares, such shares should be first offered to the existing equity shareholders. So preemptive right is nothing but a right to get the first opportunity to purchase additional equity shares offered by the company, and that will be in proportion to their current shareholding. Seventh characteristic is limited liability. Equity shareholders have a limited liability which is limited to the face value of the shares they have purchased. So students, in this video, we have seen the meaning and features of equity shares. In the next video, we will discuss about some more aspects related to equity shares. Thanks for watching and take care.